Interestingly enough, Rod, I think I've got a topic that you're very familiar with that I've seen a lot of recently, and it's companies that are still private that are issuing phantom income units to management and recommending that they file an 83B election with the IRS. And I've actually seen it 2 or 3 times this year so far. Not sure if that's a sign of something to come. And considering the 2020 calendar year we had for a lot of corporations, companies, revenues not being where they were prior and having to let people go, I thought that was interesting that three folks have kind of come with some questions. I don't know if you want to shed any light on what the 83B election is, and maybe its importance and why folks are being encouraged to utilize that.
Yeah, Joe, that's a great question. And yeah, we have dealt with the 83B election a number of times over the years. And, typically I associate it with, publicly traded companies and their kind of stock awards to their managers and executives. But I have seen it a few times over the years with, private companies. And the whole idea of it is when you're granted some kind of award of stock that typically vests in the future, you can make what is referred to the Internal Revenue Code as Section 83B. You can make an election. I think you have to make it within 30 days of receiving the award, and the IRS has a very specific format for making the election. But you can choose to have it subject to income tax now rather than waiting until the award vests. And the reason you would do that, let's just say that the private company values its stock right now at $1 a share. You make an 83B election to record income at $1 a share. You report that on your tax return. And now let's say 5 years from now, that private company goes public or gets sold, and that stock is now worth $100 a share. All of that change in value between $1 and the $100 is capital gain instead of ordinary income on a W-2. So that's the main reason to make that kind of election, and that's what we've seen and had people do.
Right, I agree. Definitely a benefit. Obviously, the takeaway there is, management's perceived idea that the company has growth potential, and because I guess we've also seen it go the other way, where in a few years that stock isn't quite appreciating like we would have expected, and maybe in that case you've paid tax up front and your shares are worth a little bit less down the road. Not the result that we would expect or hope for, but that's also potentially a risk that you run by making that 83B election up front.
Yeah, and you also run the risk, pulling into income a grant that's not vested, and then what if you leave the company and you never, the award never vests? So there's all kinds of other kind of side issues to be aware of there. So anyone who's contemplating that should definitely be, calling an advisor like yourself, Joe, or, to make sure that what they're doing makes sense. The other thing that I think of in this whole discussion is, part of the new administration's tax proposals could potentially eliminate some of the favorable tax treatment for long-term capital gains relative to ordinary income. So it's interesting to see how that may come into play at some point. But definitely, it's an interesting topic, and I think that there's definitely over the years been a lot of value to some people who've made that kind of election, that 83B election.
And it's interesting you point out potential tax changes down the road. We're always planning for today, right? We're planning under current tax code, under our current laws, and as we've seen in the past, they do change and change frequently. I can think back to the federal state exemption numbers and where they were and where they've come today, and so your plan today might unfortunately have to be rethought or changed down the road because of tax law changes or implications that come about. based on an administration or where we kind of find ourselves at that moment in time. So it's nice to have flexibility. You don't want to make a decision where you're permanently locked in and don't have an out or have another means to maybe pivot and go a different direction. But I think what we're talking about with this 83B election and capital gains rates changing, I'm not sure that, that in itself would change the outcome of a decision, but we have to take into account that tax law today might not be tax law tomorrow.
Yeah, I agree with you. And I completely agree that, your decisions based on tax law really need to be based on current tax law. You got to keep in mind that laws could change, but when you make a decision on a transaction, make it based on, does it fit the current tax law,
Right.
and does it fit your current situation?